In this section of Chapter 21, we will be looking at the difference between variable costing and absorption costing when a firm makes more units than it sells. We're still looking at the company LaserSave that we studied in the previous section. And we have been given a bunch of information about the firm. The firm's cost and price structure hasn't changed. The only difference in November compared to October is that this month the firm recycled 1,250 cartridges but only sold 1,000. Let's see how that affects our understanding of the firm's performance. Under absorption costing, the manufacturing costs will include the $23 of variable manufacturing costs times the 1,250 units that were made, plus the $20,000 of fixed manufacturing overhead. So we can determine the total manufacturing cost. To find the manufacturing cost per unit, we take the total manufacturing costs and divide by the total number of units. And we find that in November, the manufacturing cost per unit is $39. That's very odd because the manufacturing cost per unit last month was $43. So we need to think about why the cost per unit changed between October and November, given the fact that nothing in the cost structure changed. The variable costs per unit didn't change. The total fixed manufacturing overhead and total fixed selling and administrative costs didn't change. The selling price didn't change. Why did the manufacturing cost per unit change? Well, that's a very good question. Why do you think the manufacturing cost per unit decreased in November? Well, it can't be answer A, because if we think on a per unit basis, all of the variable manufacturing costs, materials, labor, and variable overhead didn't change. If we think on a total basis, the total direct materials, direct labor, and variable manufacturing overhead actually increased because the activity level increased. So A can't be the right answer. B can't be the right answer either, because the fixed manufacturing overhead was $20,000 in each month. And D can't be the right answer. That statement has to be false because we know that the manufacturing cost per unit was $43 in October and only $39 in November. That means that answer C, the fixed manufacturing overhead per unit decreased, has to be the right answer. Let's take a look at why that's a correct statement. Under absorption costing in October, we could take the total fixed manufacturing overhead of $20,000 and divide by 1,000 units. That means that in October, each unit has to carry a $20 share of the total fixed manufacturing overhead. But in November, the fixed manufacturing overhead hasn't changed, but the number of units has. So when we divide the total number of units made in November into the total fixed manufacturing overhead in November, we find that each unit only has to carry $16 of November's fixed overhead. In other words, the difference in our understanding of how much it cost us to make each unit in October versus November comes from the fact that we made more units in November. So the total fixed cost didn't change, but it was spread out over more units. So each unit had to carry a smaller load. In other words, as the number of units increases, the fixed manufacturing overhead carried by each unit decreases. Now, what would happen if we sold all 1,250 units? That would mean that all of the manufacturing overhead would still end up on the income statement as cost of goods sold. But that's not what happened here. We only sold 1,000 of these units. Let's see what effect that has on our understanding of operating income under absorption costing. Here's our $20,000 of fixed manufacturing overhead in October. Under absorption costing, each unit has to carry its share. Since we made 1,000 units, that means that in October, each unit has to carry $20 of fixed overhead. As it happens, in October, the firm sold all 1,000 units, and each unit carried its $20 share of fixed overhead onto the income statement. No units ended up on the balance sheet as ending inventory, so none of that fixed overhead appeared on the balance sheet. Now let's look at November. We still have $20,000 of fixed overhead, but when we divide by the total number of units, since there are more units, each unit carries a smaller load, in this case $16 per unit. We only sold 1,000 of these units. At $16 of fixed overhead per unit, that means that out of the firm's total $20,000 of fixed overhead, only $16,000 of that ended up on the income statement in cost of goods sold. What happened to the rest of the fixed overhead? Absorption costing treats fixed overhead as a product cost. That means each unit's share of the fixed overhead is attached to that unit. So the 250 units that didn't get sold would end up on the balance sheet as ending inventory. And each one of those units would carry its $16 share of fixed overhead onto the balance sheet. So, out of the $20,000 of fixed overhead in November, $16,000 worth ends up on the income statement, and $4,000 worth ends up on the balance sheet. Altogether, in November, the total manufacturing cost per unit is $23 of variable costs, direct materials, direct labor, and variable manufacturing overhead, plus $16 of allocated fixed overhead, for a total of $39 per unit. The firm sold 1,000 of those units. That means the cost of goods sold is going to be $39,000. But the firm didn't sell 250 units. We can multiply that by $39 per unit to determine the value of the inventory ending balance. With this information, we're ready to make an income statement under absorption costing. Sales revenue is the 1,000 units that the firm did sell times $60 per unit. We just figured out that the cost of goods sold is the 1,000 units times $39 per unit. The difference gives us our gross profit. Operating expenses include $1.25 per unit of variable selling and administrative times 1,000 units, plus the $12,000 of fixed selling and administrative. We can add those together and subtract from gross profit to get operating income for November. On the balance sheet for the firm in November, under absorption costing, we multiply the 250 units that didn't sell times the $39 of total manufacturing costs. That includes direct materials, direct labor, variable manufacturing overhead, and that $16 per unit share of allocated fixed overhead. And that gives us the total value of the ending inventory. Comparing the operating income in October to the operating income in November shows us there is a significant difference, which is very odd because in both months the firm sold 1,000 units. So why this big difference? Why do you think that operating income was higher in November than in October? Answer A can't be right because we just saw that $16 of allocated fixed overhead was capitalized in each unsold unit in November. Answer B can't be right either because for the units that were sold, $16 of fixed overhead was expensed in November. Answer D is a true statement. Some fixed manufacturing overhead was expensed in November, but some fixed overhead was also expensed in October. so that doesn't explain the difference. The correct answer is C. Some fixed overhead was capitalized in November. That didn't happen in October, when all of the fixed overhead ended up as part of cost of goods sold, because all of the units that were made in October were sold. By contrast, in November, the fixed overhead that was attached to the unsold units ended up being capitalized in the dollar value of the ending inventory. Let's take a look at the value of November's ending inventory under absorption costing. The value of the finished goods would be 250 unsold units times $39 per unit. That $39 represents the $23 of variable costs plus the $16 of allocated fixed costs. Now let's compare this firm's income for October and November. That $4,000 increase in income for November didn't happen because the firm sold more units or sold the units at a higher price or reduced its variable costs. That increase in income occurred because the firm made 250 units that didn't sell, and each of those units carries $16 of allocated overhead onto the balance sheet and away from the income statement. Now let's take a look at November under variable costing. Variable manufacturing cost was given, $23 a unit. Variable selling and administrative was also given, $1.25 per unit. Now let's make a variable costing income statement. Sales revenue is the 1,000 units times $60 per unit. Variable manufacturing costs are 1,000 units times $23 per unit. Variable selling and administrative is 1,000 units times $1.25 per unit. Add up the variable costs, subtract the variable costs from sales revenue, and that gives us contribution margin. Now we have to identify the fixed costs. Fixed manufacturing is $20,000. Fixed selling and administrative is $12,000. Add those. Subtract the total fixed costs from the contribution margin, and that gives us operating income for November under variable costing. On the balance sheet under variable costing for November, our finished goods will be recognized at the 250 units that didn't sell times $23 per unit. That is just the direct materials, direct labor, and variable manufacturing overhead associated with those units. Notice that no allocated fixed manufacturing overhead is capitalized in the variable costing method. When we compare operating income in October and November under variable costing, we notice that they're the same. That happened because none of the fixed overhead was capitalized. Remember that variable costing treats fixed overhead as a period cost, not a product cost. So each period, 100% of the fixed overhead goes to the income statement, no matter how many units are sold. Let's compare the results for November under the two methods. When we compare operating income, as you can see, the November operating income is $4,000 greater for absorption costing than for variable costing. When we compare the increase in finished goods, as you can see, the increase in finished goods is $4,000 greater for absorption costing than for variable costing. That $4,000 difference in income and finished goods represents the difference in what happened to fixed overhead. So, why is November operating income greater under absorption costing than under variable costing? Well, it can't be answer A, because fixed overhead is never capitalized under variable costing. It also can't be answer D, because fixed overhead was capitalized under absorption costing in the units that were made but not sold. So we could say that some fixed overhead was capitalized under absorption costing. We can also say that no fixed overhead was capitalized under variable costing. These are both good explanations of what happened in November.